Hi everybody, welcome to the video for Thursday, February 11th, 2010. Today, the big news of course is that as expected, the EU pledged to help out Greece. The exact details at this time, in terms of what form the help will take, are still unknown, but it's expected that loan guarantees will play the leading role, with Germany providing the bulk of support. But in our opinion, this is a risky proposition because if the EU gives these guarantees, then it could make it even more difficult in the future to enforce fiscal discipline because it allows troubled countries the option of simply deferring the problems. And once these guarantees are in place, the threat of removing them could trigger another crisis. And there are other troublesome questions as well, such as who might get these guarantees, how these guarantees will work, and how long they'll last, and so forth. The bottom line is that for the EU, and the euro, there's simply no quick and easy answers. More bad news is likely to come from these troubled, debt-heavy economies, which includes the US, by the way. We think that this will weigh the heaviest on financial stocks. And over the longer term, the winners we expect will be emerging markets, who tend to be faster growing and lower debt economies. And in turn, this will also benefit what these stronger economies consume more. That is notably commodities. And also, in other news, the Fed appears to be gradually laying the groundwork for future moves to tighten credit. Chairman Bernanke said earlier this week that the Fed may soon raise its discount rate before long. Now, raising the discount rate would give banks more incentives to keep more funds with the Fed. The discount rate basically is the interest rate that the Fed charges for emergency loans that it makes to banks. And this is different than the federal funds rate, which is the key short-term interest rate that serves as benchmark for many other rates. But with the economy still subdued and unemployment still very high, the road to meaningfully higher interest rates will likely be long and winding. In fact, many Fed watchers now expect that there won't be any significant tightening from the Fed until next year. That's it for today. Thank you for watching, and join us again soon.